Hello and welcome to our next case study here. This is a 60-minute mixed office retail acquisition modeling test. And you can read through this whole document, which is fairly short. It's only 2 or 3 pages to get the basic idea. But to summarize, now we're moving across the country and we're looking at an office/retail property in Manhattan, which is a lot more expensive. It's 92% leased right now. It has 3 tenants, and the basic idea is that we're going to try to boost the property's value by getting these tenants, which are currently on 5-year leases, or at least 2 out of 3 tenants are on 5-year leases, and getting them to sign 10-year leases in exchange for below market rental escalations. So the idea here is that by getting them to sign longer term leases, we can potentially make the property more valuable and at least get to a more stable net operating income. So we're going to acquire the property along with an operating partner. We'll hold it for 5 years and then we'll sell it at the end of the 5-year period. We have some assumptions here for the operations of the property, as well as something called the rent roll, which lists the individual tenants and the assumptions that we make for their rent and their leases, from how much they're paying to what expenses they pay for to when the leases expire. We have a variety of different lease types here, different lease expiration dates, and also different rent per square foot figures. And then we have some acquisition and exit assumptions, which we'll get into in the next lesson after this. And then we have to answer some case study questions and say whether or not we do the deal, whether or not lenders would approve of this deal, and then whether or not the operating assumptions are realistic. So that's the basic idea. Now, to summarize the differences between this case study and the previous one, we'd say there are 3 main differences. First off, we have a rent roll and more granular assumptions for the tenants. Rather than just assuming that a certain percentage of square feet expire each year, we're actually going to model it out and look at what each tenant is paying us and what we're paying in terms of free rent and turnover vacancy and tenant improvements and leasing commissions for each of these tenants, and also what they're paying us in terms of expense reimbursements. So all of this is a lot more granular now because we only have 3 tenants in the whole property. We're also going to use multiple tranches of debt and equity here. So whereas before we just had one senior loan for the property, now we're going to have something called mezzanine, which is a higher risk, higher potential return form of debt. We're also going to split up the equity because we have an operating partner. The operating partner will contribute 10% of the equity, and the way that we split up the equity returns here will be different because we now have 2 sources of equity capital. Finally, we're going to create something called a waterfall schedule at the end. Now, the one here is very, very simple, but we're going to have to split up the cash flows based on the equity contributed and the performance overall. So if the IRR goes above a certain amount, we're going to split up the cash flows differently. If it's below a certain amount, then we're going to also split up the cash flows differently. There are dozens or hundreds or maybe even hundreds of thousands of different ways to set up this type of waterfall schedule. And so this is just a simple introductory example. We'll look at a lot of different approaches throughout the rest of this module in these simplified case studies and also in the more complex case studies later on. So in this first lesson, we'll complete the pro forma for the property and look at the lease by lease revenue and expense projections. And then in the second lesson after this, we'll complete the debt service projections, we'll calculate the IRRs, we'll create the waterfall schedule and answer the case study questions. That may seem like a lot, but it's actually pretty simple because you should already know how the debt service works from the last time around. Same with the IRRs. And so really, we're going to be focused on the waterfall schedule and the case study questions and answers. This lesson, we will divide into 2 main parts and look at the tenant lease projections first. Then in part 2, we'll complete the property pro forma down to adjusted net operating income. Let's go to part 1 first and look at the tenant lease projections. To save some time here, I've already entered all the assumptions that were provided to us in the case study document. For tenant number 1, we can start there because they also have a fairly simple lease type, full service, which means that the tenant is not responsible for paying any expenses. They also have the highest rent per square foot. Since they're not responsible for expense reimbursement at all, they're going to generally pay higher rent than a tenant that has a single net lease or a triple net or double net lease. In all those cases, the tenant is responsible for some portion of the property expenses. Let's start with the baseline rent per square foot here, which starts out at $120. The language in the case study document is a bit vague. They just say 4% growth declining to 3% growth in the last 3 years, but they're not giving us exact numbers. So I'll just say 4%, 4%, 4%, and then 3%, 3%, and 3%. And then we can make this escalate by multiplying by 1 plus the growth rate in each case and copy this across. Based on that, we can get to the base rental income here. So we'll just take the baseline rent per square foot in each year and multiply by the rentable square feet that this tenant is occupying. We'll anchor the column part so this doesn't shift around, and then we will copy this across. Now for the absorption and turnover vacancy, here, since we're looking at it on a tenant by tenant basis, we need to think about when the lease actually expires. The answer is the end of 2019. So in 2020, we have to think about this case where the lease expires and where we need to find a new tenant. I'll just enter 0 as hard-coded figures in the first 3 years. And then in fiscal 2020, we need to now factor this in. So let's take our base rental income right here, and then let's multiply by 1 minus the renewal probability. So there's a 70% chance this tenant just renews and stays in the same spot. But if they do not, then we need to look at the 30% case where they do not renew and where we need to find a new tenant. When we need to find a new tenant, generally you assume that it takes a certain number of months to do so. In this case, the case study document told us that the downtime months are 6, which means that we spend about half the year looking for a new tenant on average. So let's take the downtime months and then divide by the total months in the year, which is a named cell up at the very top, months in year. So we have that. And then we'll hard code zeros for these remaining years. The new lease term is 10 years here, which means that throughout the rest of this holding period for fiscal 2021, 2022, and 2023, we don't have to worry about lease expirations at all, because regardless of whether this tenant renews or we find a new tenant, the lease expiration is going to be all the way out in fiscal 2030. So it's just not an issue here at all, really. Now, for the concessions and free rent, the setup will be similar. We have 3 zeros in the beginning because we don't have to worry about it at all. We only have to worry about this if and when the lease actually expires. When it does expire, typically to find this new tenant, we also give them some type of incentive in the form of a certain number of free months of rent. If it's an existing tenant that renews, we also may provide this, but typically it'll be lower because they're already there. We don't need to give them quite as much of an incentive because they're not brand new to the property. So let's take our base rental income here. Let's multiply by 1 minus the renewal probability of the 70% up here. And then let's figure out the proportion of the year for which they'll receive free rent. That'll be the months of free rent under the new tenant column right here. And then we'll divide by the months in the year, which is just 12. So we have that. And then let's look at the case where we actually have this existing tenant renew. So we'll take our base rental income, we'll multiply by the renewal probability, the 70% case here, and then we'll multiply by the renewal months of free rent, 3, and divide by the total months in the year, 12. So we have that. The 3 years after this, we'll just enter 0 because the lease expiration is so much further out that we don't need to think about it at all at that stage. For the tenant improvements and lease commissions, we'll enter zeros for these. And then for the tenant improvements, we need to base this on the rentable square feet that's occupied because the tenant improvements are almost always linked to a per square foot or per rentable square foot value. So we'll link to that first, and then we'll multiply by 1 minus the renewal probability to get the non-renewal case, and then we'll multiply by the TIs per rentable square foot for brand new tenants, which is 10 here. Then we'll link to the same rentable square feet occupied number. We'll multiply by the renewal probability, the 70% case, and then multiply by the renewal TIs per square foot, which again is less generous. The tenant's already there, so we don't need to incentivize them quite as much in this case. We have that, and then we'll enter zeros in these last 3 years. And then for the leasing commissions, this one gets a little bit trickier because leasing commissions are almost always based on the full value of the lease. If we're making a new or renewal tenant sign a lease for 10 years, therefore, we need to think about how much that lease is going to be worth over 10 years and then multiply this 3% or 1% by this figure, and then probability weight it and have one that's multiplied by 70% and one that's multiplied by 30%. Let's start by taking the 30% case, so 1 minus this renewal probability. Then we'll multiply by the baseline rent per square foot right here times the rentable square feet occupied. This gives us the lease value for 1 year, but we need to look at this over 10 years. Now, ideally, we would like to escalate this and factor in the fact that rent might be going up by 3%, 2%, 4% each year, something like that. But we just don't have the time to get into that in this particular exercise. So we're just going to simplify it a little bit and just take this number and multiply by the 10-year lease term right here, and then multiply by the new leasing commission percentage. This is how much we pay to the broker who helps us find this new tenant. So that's it for one case. We should also put a negative sign in front of this because it is an expense. And then we need to look at the other case where we actually have a renewal. So we'll take the 70% right here. We will multiply by the baseline rent per square feet. We will then multiply by the rentable square feet and anchor the column part. And then we'll multiply by the 10 years in the term, and then we'll multiply by the 1% commission that we pay for a renewal tenant. Sometimes you might even see 0 assumed for the leasing commissions if there's a renewal, but we'll be a little bit more conservative here and say that we still have to pay the broker something for getting this tenant to renew in the first place. So we have that, and then we'll enter hard-coded zeros for the others. And so that's all we really have to do here. It gets a little bit tricky to think through the renewal probabilities and what we do for the leasing commissions, but the rest is pretty straightforward. And the case study document lays out all these assumptions if you're wondering where these are coming from. For tenant number 2 and number 3, the setup is very, very similar. The main difference is that since these are single net or triple net leases, we will have expense reimbursements here, but the fundamental setup is not really that much different. To illustrate what happens, let's actually go down to tenant number 2 and tenant number 3 now and fill in these numbers. For tenant number 2, they tell us that there should be 5% growth declining to 3% in the last 2 years, and that the initial rent per square foot is $105. The lease expiration date is the end of 2020. So based on that, we can start this out at 5%, and then we can go down to 4%, 4%, 3%, and 3%. And we could have also done 4.5%, 3.5%. It doesn't really make that much of a difference. Let's go down and bring in our rent right here. And then this one, the lease expiration date is 1 year later. So what that means is that we can take all of our assumptions here. We can actually just copy down exactly what we have above, but we need to move the assumptions for the absorption and turnover vacancy, concessions and free rent, tenant improvements, and leasing commissions over 1 year. If we've anchored everything properly, then this should work as is, and we shouldn't need to modify anything here. So you can go through and look at it. But since we're assuming the same renewal probability, the same months of downtime, the same capital costs in terms of tenant improvements, leasing commissions for each tenant, we don't need to do anything special here. We should just be able to copy it down, and it should work properly. And then finally, for tenant number 3, this is even easier because the lease expiration date is past the end of the holding period. So we don't need to worry about turnover vacancy, free rent, TIs, LCs, or anything like that here. The case document tells us that there should be 6% growth declining to 3% in the last 2 years, and the rent per square foot is $90. So we'll say 6%, 5%, 4.5%, 4%, 3%, and 3%. And then let's copy down the numbers right here. And let's also get the base rental income. And then for everything else, we can just hard code these as zeros because lease expirations will not factor in at all. This tenant is already on a 10-year lease. Turning our attention to the expense reimbursements now, this is where it gets a bit tricky. The rule of thumb with expense reimbursements is that you have to read the terms of the lease and the fine print very carefully. There are some general rules of thumb that we'll go over here, but each lease is different. There are many exceptions to the rules. And when people try to classify these and create categories to explain them online, for example, or in textbooks, they often leave out the fact that you will see many, many variations and exceptions. In a single net or just single N lease, the tenant is responsible for their pro rata portion of the property taxes. So if they occupy 10% of the building, they should pay 10% of the property taxes. In a double net lease, the tenant is responsible for their pro rata portions of property taxes and insurance. And in a triple net lease, the tenant is responsible for the pro rata portions of property taxes, insurance, and common area maintenance. Often, common area maintenance is grouped together with common area utilities. So you'll see those both listed together. Now, people often say that all the expenses are passed through. In other words, they're simply passed on to the tenant. But if you look at the pro forma here, you'll see that it's not really true. Common area maintenance, utilities, insurance, and property taxes are passed on to the tenant. However, property management fees and the reserves are not. And we consider both of these to be major expenses. Maybe they'll be a bit less than all of our operating expenses and property taxes, but they're still fairly sizable expenses here. These are almost never paid by the tenants, so you have to be really, really careful with the assumptions. Also, note that these utilities here refer to the common area only. So tenants are typically responsible for paying their own utilities for the space they occupy, and that won't even show up on the pro forma because it's not something that we as the landlords or owners ever really think about for the most part. Again, there are many exceptions, but these are just a few examples of why you have to be careful with what people say about different lease types and triple net leases versus what actually happens in real life. So to get these expense reimbursements, just the property taxes for tenant number 2 and then more categories for tenant number 3. First, we need to come up with some estimates for the actual expenses here. For the property management fees, we can't really say anything yet, and we don't need to worry about that because that's going to be linked to effective gross income. But we do need to fill in maintenance, utilities, insurance, real estate, and property taxes. And while we're doing this, we might as well fill in the assumptions for the reserves. For common area maintenance, let's go up to the top. The case study document, if you go to the rent roll and operational assumptions, gave us the numbers for all of these. So common area maintenance will just be the $5 per rentable square foot, and let's multiply by the rentable square feet in the property. Common area utilities will be very similar. It's just a per square foot value times our rentable square feet. Insurance will also be similar. This is just a per square foot value times our rentable square feet. Real estate and property taxes will be different. And as is usually the case, this is actually based on the property value. In New York, property taxes are extremely high at 4% of the property value. This is a simplification. The way you actually calculate it is different, but on average for a property like this, it'll come out to be about 4% of the property's value. So to calculate this, we need to calculate the actual acquisition price first. The case document tells us that the owner will only accept $1,000 per rentable square foot. So we have the rentable square feet. Let's multiply by the $1,000 per square foot. And so we have our acquisition price of around $25 million right here. Based on that, we can now go down and we can make the initial real estate and property taxes linked to the $25 million times the 4% right here. So we have that. Now at this point, we might as well also fill in the reserves because these will also be linked to a per rentable square foot value. So it's $250 per rentable square foot here. And then let's multiply by the rentable square feet. And so we have that. Let's also now make these expenses all grow by the appropriate rate. So for common area maintenance, this is supposed to grow at a 3.5% annual rate. For common area utilities, this is supposed to grow at a 3% annual growth rate. Insurance is supposed to grow at a 2.5% annual rate. Real estate and property taxes initially will be based on the property value, but often models, you just assume that they grow at a simple percentage growth rate going forward to simplify things a little bit. And also because that tends to be how cities and towns tend to assess this. They usually do an appraisal each year, base the taxes on that. And oftentimes they end up assuming that the value goes up by a simple percentage. And then finally for the reserves, let's take the old number and then multiply by the growth rate right here. So we have this, and let's copy this all the way across. So we have that. And now let's go up and get our expense reimbursements for tenant number 2. It's a single net lease, so they're only responsible for paying their pro rata share of the property taxes. Let's go down and take it for the historical year. And then we need to take the square feet of space that they occupy, which we can anchor, and divide by the total number of rentable square feet in the property. So we have that. Now, you might think that we could just copy this across and it'll be very simple. And for the most part, it is, but you have to be careful because in the year in which the lease actually expires, or the year in which we assume that we have to find a new tenant, fiscal 2021, it's not quite so simple. The issue is that if the lease expires, the tenant doesn't renew, and we need to find a new tenant, this space is not going to be occupied for the entire year. So instead, what we have to do is take this and reduce it by the amount of time that the space might be vacant in this year. So we'll start by taking this number and just reversing it. And then we need to multiply by 1 minus the renewal probability. So the 30% chance that the property is vacant for some amount of time. If it is vacant for some amount of time, it's going to be vacant by 6 out of 12 months in the year. So we have essentially reduced this. And if you think about the math here, it's roughly 15% lower than it was before. Why? Because there's a 30% chance the tenant will not renew. And if the tenant does not renew, it stays vacant for half the year. So 50% times 30% gives us a reduction of roughly 15% right there. And that's how that works. For the rest of these, we won't have to worry about this, so it is very straightforward. The expense reimbursements for the triple net tenant will be easier, not only because they have a triple net lease, but also because the lease expiration date is in the future. We don't have to worry about any of this business with the suite being unoccupied for a portion of the year, at least in the holding period that we're looking at. So for this one, there's always some question over what triple net actually means, but the case study instructions are pretty clear about it, and they say that the tenant is responsible for share of common area maintenance and utilities, insurance, and property taxes. So we know exactly what to include here. Let's go down and take all these numbers. Common area maintenance, utilities, insurance, and property taxes, but not the reserves or the property management fees. And then let's multiply by the rentable square feet occupied divided by the total rentable square feet in the property. And we can just copy this across very simply, and that's all there is to this one. And with that, we're actually done with the tenant by tenant projections. Technically, we could still look at the replacement reserve and the annual capital costs, but we'll save that for the next part in this where we look at the property pro forma. On that note, let's go into the property pro forma now, down to the adjusted net operating income. For the most part, this is pretty straightforward if you understand how it works from the first case study, but you have to be careful of a few things. Remember that this building is only 92% leased right now. We have 2,000 square feet that's vacant, which you can see if you just sum up these numbers. 10,000 plus 7,000 gives us 17,000, plus 6,000 gives us 23,000 of square feet versus 25,000 of rentable square feet in this property. So we need to factor that in. Absorption and turnover vacancy, concessions and free rent, expense reimbursements will all be easy because we calculated them above. We just have to sum them up. General vacancy will be easy as well because we can just flip around what we do in the base rental income calculation. So let's do that right now. And for base rental income, let's take our base rental income for tenant number 1. Let's take it for tenant number 2. And let's take it for tenant number 3. Then let's take our rentable square feet and subtract the amount of square feet that each of these tenants is occupying. We're going to anchor these so these do not shift around at all. We're not going to worry about column versus row versus anchoring everything. And then we need to assign some type of value to these unoccupied square feet. To simplify things, we'll just use the values for tenant number 1 and assume that if we had a tenant occupying that last 2,000 of square feet, they would be paying the same rate as tenant number 1, and it would be a full service lease. We have that, and we can copy that across. For these others, let's just go up and get the absorption and turnover vacancy for each tenant. Concessions and free rent, we can just copy down that formula. And then for expense reimbursements, tenant number 1 doesn't even have a line item for this, so we can skip that. Let's add these up. And then for general vacancy, we can just take this part of the formula with the rentable square feet minus the occupied square feet and just reverse it down here and put a negative sign in front. And we'll copy that across. We have that. And then for the expenses, we've actually filled in a lot of these already because we had to for our expense reimbursements. But there are a few that we haven't filled in yet. We need to get the property management fees. We also need to look at what's happening with the CapEx, tenant improvements, and leasing commissions, and how this works with our reserves. Now, the property management fees I purposely saved until the end, and I have a note about it over here. The issue is that these are almost always based on the effective gross income of a property. So we need to get that effective gross income before we can calculate it. Of course, the effective gross income depends on the expense reimbursements. The expense reimbursements depend on these operating expenses and property taxes. So before we could even think about calculating property management fees, we have to calculate these other expenses first. Now that we have that though, it's fairly easy. We just take our effective gross income and we multiply by the 3% property management fee percentage. We have that, and let's sum these up. We'll copy across the property management fees first, and then we'll copy across everything down here. We can now calculate our net operating income, which is very similar to EBITDA for normal companies. It represents the recurring cash flow from core business operations of this property before factoring in capital costs and reinvestment in the business or property and things like that. We can also look at the margin here as a percent of effective gross income and copy this across. Now, for this business with the reserves, remember the reserves exist to smooth out the property's performance. We know that we're going to have to spend something on capital expenditures, tenant improvements, and leasing commissions over time. So we set aside something in the reserve to pay for it. We add to it each year. And then when we need to use something from it, that's what the capital cost paid from reserves represents. So instead of having to pay that 100% with cash, we can use some of our reserves instead. Of course, to calculate this, we need to get to our annual capital costs each year. So let's go up and take our tenant improvements and leasing commissions for each tenant. I'm using positive signs here because these are already listed as negative for each tenant, so we don't need to flip the sign or anything like that. And then for the replacement reserve amount, you could assume this is 0 initially, or you could assume you put something into it. In this case, in the case study instructions, they tell us that there will be $62,500 in initial replacement reserves. Now, we don't have all the acquisition and exit assumptions yet, but we can fill that in. If you think about the numbers here, or you just try to calculate it yourself, under uses of funds, if we just take our replacement reserve per rentable square foot per year and then multiply by the rentable square feet, that gives us exactly $62,500. So essentially, we're assuming that we start putting something into this reserve in the very beginning when we acquire the property, rather than waiting to do it in year one. You will often see some amount allocated to this replacement reserve within the sources and uses schedule, but the exact amount depends a lot on what you're doing and the deal type and the region and other factors like that. In any case, though, let's just link to our initial amount right here so we have it. And then for the replacement reserve and how it changes each year, let's link to the old number first. Then let's go down and let's subtract the reserves allocated right here. Really, we're adding it because we're flipping the sign. This is already negative, so we flip the sign and we add this. And then let's subtract the capital costs that are paid from the reserves. So we're subtracting F140. This will be a positive on the pro forma. So we want this to actually reduce our reserve, and so we're subtracting it right here. And now we've copied this across. Now the reserve keeps going up here because we haven't finished making these calculations yet. So let's go down. And for the CapEx, TIs, and LCs each year, let's link up to our annual capital costs. And then for the capital costs paid from the reserves, we're going to take the minimum between this number, how much we actually owe in each year, and then our initial replacement reserve amount from the beginning of this year or the end of last year, minus however much we've allocated into it this year. We're doing it this way instead of just taking the number for this year so we can avoid a circular reference. This part is just checking how much we owe each year versus what's in our reserves. And if the amount that we owe is less than what's in our reserves, we can assume that we can fully cover it with our reserves. On the other hand, if it's not, if our reserve amount is less than this figure, then all we can do is put everything in our reserves toward it, and then we'll owe something beyond what's in our reserves to meet the full cost. For our adjusted NOI, let's take our NOI and then add these two items up. We can copy down our margin assumption here, and then we can copy across everything. And now you can see exactly how this works. Initially, when we get to year 3 in this model, we have enough in our reserves to cover it. But then when we get to year 4, we do not. So we can cover some, but not all of this with what's in our reserves. You can also see how the reserves work. It keeps going up initially, but then it goes down as we pay for a big portion of those capital costs. We have more capital costs in the second year, and we don't have enough in our reserves to meet it. So our reserves actually go to 0, and then they start building again toward the end. So that's it for part 1. We have everything down to net operating income now. Let's do a quick recap and summary. In this case study, the main differences are the more granular tenant assumptions, which we looked at in this part, multiple tranches of debt and equity, and a waterfall return schedule for equity investors at the end. We focused on the pro forma and the lease-by-lease revenue and expense projections here, and you saw how many of the terms vary based on the lease type. Full-service leases tend to have the highest rent, but the tenant is not responsible for expense reimbursements. By contrast, single net leases have lower rent, but the tenant has to pay their share of property taxes, and with triple net leases, the rent tends to be lowest, but the tenants owe common area maintenance and utilities, property taxes, and insurance. The main challenge in projecting these numbers for each tenant was factoring in the absorption and turnover vacancy in the year after which the lease expires, the concessions and free rent and probability weighting that, and then factoring in the tenant improvements and leasing commissions. And you saw how we made simplifying assumptions in some cases, such as for the leasing commissions, so that we can get the full lease value and then take a percentage of that for the commissions. With the other two tenants, with the expense reimbursements, we had to fill out the operating expenses and property taxes for this property first. Once we had those, we could go back and then split this up proportionally. One tricky part here was that for the expense reimbursements for tenant number 2, since the lease expires, we have to reduce the expense reimbursements by about 15% to represent the fact that there's a 30% chance of non-renewal. And if there is a non-renewal, the space will be vacant for about half the year. For tenant number 3, it was pretty straightforward and is just based on all the expenses for which this tenant is reimbursing us. Then we assembled everything into our pro forma for the property. We looked at our base rental income and factored in the vacant space as well. We added up the numbers to get the other categories here. We deducted the 2,000 square feet to get the general vacancy. We calculated our property management fees, and then we worked through our business with the reserves and the CapEx, TIs, and LCs at the bottom to get to our adjusted net operating income. That's it for part 1. Coming up next in part 2, we will look at the debt and equity and the debt service, the returns, and create our simple waterfall schedule. Use it to answer our case study questions.